Marko Papic is Chief Strategist at BCA Research. He's with us. Marko, great to have you with us here. Thanks very much for your time. You know, I was just thinking when this Russia-Ukraine thing started, and who thought, right? I mean, there was a flurry of negotiations early on that, well, you know, we're going to sort of end this and that in 3 years now. With regards to Iran-Israel, I mean, surely you know, these wars without an end. What's your sense, Marko? How do you look at the entire thing? And do you think it'll escalate from here or de-escalate?
I think you always have to escalate first to de-escalate. So I think there's probably more escalation coming. But the big difference is that it's highly unlikely anyone's going to invade Iran. And you can't really force regime change with an F-16. That would be highly unusual. It's really only happened once in recent history. So because of that, I think that there's a natural limit to how far this conflict can go. No party of this conflict wants to put ground forces really anywhere. Whereas in Russia-Ukraine situation, you did have one party that definitely wanted to put troops on somebody else's territory.
So escalate to de-escalate, which means from a financial market standpoint, what? I mean, so far things have been pretty contained, although oil jumped once again last night.
Yes, I think in the near term, I can definitely see oil prices going to 85, maybe even 90. But here's the fact. It doesn't really matter what Israel does. It doesn't matter what the US does. For investors, the only country that we should be focused on is Iran. Because it's very simple. Iran is either going to try to take oil barrels off the global market by interjecting the flow of oil through the Straits of Hormuz. It's either going to try to intervene in the shipment and the production of energy, or it's not. And if it does start to impact the flow of oil out of the Straits of Hormuz and out of the Middle East to the rest of the world, it's going to invite a pretty significant retaliation by the US against it. A retaliation that will really make Israel's attack look like a bee sting compared to a grizzly attack. So this is not something that Iran will choose to do lightly. And remember, in the 46-year history of the Islamic Republic of Iran, it's never tried to stop the flow of oil through the Straits of Hormuz. And there's a reason for that, because that really is the nuclear option, after which the retaliation by the US is going to be pretty swift and pretty dramatic.
So assuming that we, just edge towards that and not actually do it, do you think this elevated tension is an opportunity for one to increase their allocation to equity? What would one's asset allocation strategy in a situation like this be?
Well, you're reading my mind. That's exactly what I'm thinking. There's nothing bearish about what's going on right now. Oil prices can go to $150, let's just say. If oil prices go to $150, S&P 500 will fall. You have to close your eyes and buy on that. And there's really two reasons for this. Number one, the US will decimate Iranian capabilities at that point. But also, it means that the ability of Iran to stop the flow of crude through the Straits of Hormuz is temporary. There's going to be a temporary moment where crude stops flowing. I think between 2 and 4 weeks is the maximum that Iran can do at the best of time, maybe even less, given their inability to defend their airspace even after against Israel, let alone the US. So yes, this is not a reason to be bearish equities. Now, I hear some clients say, yes, but this could significantly impact inflation and therefore central bank monetary policy calculus. And I just think to myself, what central bank governor or president is going to hike interest rates because of a conflict in the Middle East that is temporary in nature? I just don't see anybody doing that. That would be, political suicide. So I don't see that happening either. It's very difficult to get cyclically bearish equities because of this moment.
All right. Hi, Marko. Good morning and good to see you in. Nigel on this side. Marko, the hope here in the Indian markets is we do not see anything above $100 per barrel. That said, the other factor that we track globally is the dollar index. And I recall when the dollar index was rock solid, you had called out that you said maybe in the second quarter of this calendar year, the dollar index could peak out. And that seems to be the case. Even in these uncertain times, you're not seeing a flight to safety, which is the dollar index. How do you see this one move from here on? It's holding at around the 99 odd mark.
You know, when something happens in the markets that should create a very clear outcome, and that outcome doesn't happen, you have to understand that something is fundamentally shifting. You know, I remember when Mosul fell to the Islamic State back in 2014. I believe it was May 2014. Clearly a bullish event for oil, and oil just had a little blip. That was the moment when I realized that, wow, you know, oil prices are going to collapse, and they eventually did over the course of 2014. Similarly, this time around, you have Israel and Iran exchanging ballistic missile fire. If there was ever a safe haven flow that should have buoyed American assets, this is it. And yet you get a little blip in the US dollar. That tells you that we're in a structural secular shift. I expect another 20% decline in the US dollar against major currencies over the next 3 years. And so we're at the beginning innings of that move.
All right. And what about positioning in terms of equity markets then? From an emerging market standpoint, a weaker dollar normally means that flows, tend to move towards emerging markets. What is your reading of it? Yeah.
Yeah, sorry to interrupt. Of course, it depends, right? Sometimes it can, sometimes it doesn't. The big question is the flows. Is the dollar falling for the right reason? And in my view, so far, it's not an uncontrolled collapse in the US dollar. It is flow, and those flows will go to Europe, to emerging markets, to Japan. And I got to tell you, the big resistance for most of my clients in the West in investing in emerging markets is kind of lack of imagination. Well, what productivity gains are happening in emerging markets? What businesses are starting? What entrepreneurs are starting businesses? It doesn't matter. Look, when the flows move into an economy, what happens? Currency appreciates. What happens when a currency appreciates? The central bank gets to cut interest rates. What happens when you cut interest rates? Entrepreneurs, businesses, technology starts, loans get borrowed. You start thinking about starting a business. You start thinking about entrepreneurship. And that's why it's such a big deal for the emerging markets, including India, that US dollar could be weakening on a secular basis.
Right, 20%, right, from here. And we've been making that point since Monday, the fact that US treasuries, no demand for bonds, no demand for dollar, even though this conflict has sort of erupted. And that's quite telling. Sometimes, as you said, what doesn't happen is more important than what does happen. I just want to quickly get your reaction to this bit of news, which I'm going to put out on the screen now. So these are U.S. media reports, Marko. Pakistan Army Chief Asim Munir is to call on U.S. President Donald Trump later tonight. Trump is going to have lunch with the Pakistani Army Chief in Cabinet Room in the White House. I mean, I don't know what to make of it. I mean, this is, it's absolutely crazy if you think about it, especially after what has happened with those attacks in Kashmir. And Trump, of course, over the last many weeks, actually, as I think 5 or 6 times said, well, he was in the middle of the negotiations, and he kind of sort of, used trade as a tool to ask both sides to pull back. But what do you make of it, if anything, Marko? I mean, geopolitics is a big part of it now.
You have to understand, President Trump's got that sort of realpolitik view of the world. So there's no real allies, there's no real enemies, there's just interests. And so that's the first thing I would tell the Indian audience, that it shouldn't sort of hang its hat on some alliance with the US. Yes, the two countries are allied against China on some sort of level, but this is a different United States. It's far more Machiavellian than it is magnanimous. So that's the first point I would say. The second point is I wouldn't read too much into it. And it's a very strange meeting. A president of a country usually doesn't meet a counterpart, anyone other than the counterpart, another president. That's the protocol. So this may actually be related to what's going on between Iran and Israel. And Pakistani military, which has, for all its faults, it has pretty deep links with the US military establishment, given the operations in Afghanistan. They could be an interlocutor between Iran and the US. So that's a different angle to take this. It may not really be concerning India-US relationship or India-Pakistan relationship.
Now, points taken. Pakistan does, of course, share a border with Iran. And there were some reports yesterday that they've closed the border with Iran, but unconfirmed reports. On that point about the president of the US meeting the Pakistani army chief, I guess that's quite telling too, right? I mean, in terms of who runs that country, it is the army. But yeah, points taken. Marko, thank you very much for joining us. More later. Appreciate your time here on CNBC TV18. So that is the view coming in as far as geopolitics is concerned.